Hi, Lenore here, and I want to go over this problem with you. I've posted it on Canvas so that you could download it as a PDF file and look at it while we're talking or make notes on your copy. This is the Matrix Corporation. It's from an exam I gave in fall, I think, of 2015. So this is what you'll be given on your exam. It will be a balance sheet, and you will have additional information listed. So where do you start? This is how I start, and I hope it'll help you. The first thing I do is determine, is the balance on the balance sheet increasing or decreasing? So we're moving from 22 to 23. That's an increase. And the amount is 1 or 1,000 because this is in thousands. And I do this for every single account. So let's continue from 40 to 39. That's a decrease. And that's a decrease of 1. 44 to 43. That's another decrease of 1. Property, plant, and equipment is going from 500 to 587. That's an increase. And the increase is 87. Now you'll notice I didn't put a formula in here. And the reason for that is, if I found for myself, if I use a formula and it comes out to be a negative number or a number in brackets, that will confuse me. So the amount section is just the whole number, not whether it's greater than 0 or less than 0. So we have accumulated depreciation here, and we're moving from 347 to 359. That's an increase. And 359 less 347, that's an increase of $12,000. Again, you'll notice I put in a little formula here, but I used the actual numbers, and I made certain that the larger number was first. And now we have liabilities and stockholders' equity. But before I go on, I want to highlight a few things. First of all, we don't begin with cash. We're using the indirect method where we begin with net income. So cash isn't important yet. Also, I'm going to highlight these items here because these two, accounts receivable and inventories, those are current assets. Property, plant, and equipment, that's a long-term asset. So I've just highlighted the current assets, and if you remember, current assets will appear under the operating section. Let me do that first for the liabilities, and these are current liabilities, accounts payable, accrued liabilities. Accrued liabilities would be something like salaries payable, rent payable, and then we have our income tax payable. Everything else, bonds payable, as I said, is a long-term liability. Common stock is equity. So we're moving from 26 to 30. That's an increase. And that increase is 4,000. 18 to 15, that's a decrease. And that's a decrease of 3,000. And income taxes payable are moving from 40 to 39. That's a decrease of 1,000. So those are our current liabilities. Let's move on to bonds payable. They're moving from 120 to 109. That's a decrease, or also known as a pay down or retirement of the bonds. And the difference between these two, 120 less 109, is 11. So that's a decrease of 11,000. common stock moving from 50 to 51 is an increase of 1,000, and retained earnings is moving from 5 to 89. That's an increase, and again I'm going to use just the numbers in the equation. That's an increase of 84. So now I've indicated all the balance sheet accounts and whether they're increasing or decreasing. The next step is to look at the information given. So there's two pieces of information here. The company sold equipment for 20, and the second piece is net income is 116,000, and the company paid a cash dividend. We're not going to use the increase in retained earnings as we show it on the balance sheet. Retained earnings is actually made up of two pieces, and those two pieces are net income, which increases retained earnings, and cash dividends paid, which decreases retained earnings. So this is how I would suggest you go about it. Retained earnings is equity, therefore it increases with a credit. The beginning balance is 5. The ending balance, let me put a line here to make it look more like a T account. The ending balance is 89. Now I mentioned that net income would increase. I'm going to put net income in here of 116. Now if we do the math, and I'm going to do the math right below, beginning balance is 5 plus 116 of net income. That comes to 121, not 89, which is the ending balance. That's a clue. And the clue is that we have a cash dividend paid. Cash dividends will decrease retained earnings. So cash dividend. And the cash dividend is now the difference between what we have, 5 plus 116, less the ending balance. So I'm going to put that in, 121 less the ending balance of 89 is 32. So I'm going to check it one more time because sometimes when we use our calculator we can make mistakes. So we're going to have the beginning balance, which is 5, add to that the 116, which is net income, reduce that amount by what we calculated would be the cash dividend, and this answer should equal 89 if I've done it correctly. There we go. So we have two pieces of information now. We know we were given what the net income was, but now we know what the cash dividend is, and we did that by determining by creating our T account for retained earnings. So we know that. Now let's go back to the first sentence. The company sold equipment for 20 that was originally purchased for 7 and that had accumulated depreciation of 1. I always tell students, create the original journal entry. So let's do that now in this little location. So we're going to debit cash. It states that the company sold the equipment for 20. So I'm going to put 20 here as a debit. Now I know when I sell an item, I have the cash amount, and I need to remove from my books the actual equipment at its purchase price. So let's put in here a credit to equipment, and the purchase price is 7. Now if you remember from financial accounting, if you remove the asset, the long-term asset, you also have to remove with it the accumulated depreciation. So we're going to debit accumulated depreciation, And we're given that information right here. It was 1. So if we look solely at this journal entry right now, we can see that total debits equal 21 and total credits equal 7. Knowing that journal entries must balance debits and credits, we realize that we need a credit. If we need a credit, that's a gain on the sale or a gain on the disposal of an asset. I'm going to put equipment in here so you know where it's from. And now we just need to balance this journal entry. I'm going to do that with a formula. I'm going to add the two debits together, 20 plus 1 less the credit, which is equipment, of 7. And that gives me 14. So from this first sentence, we now have two pieces of information that we have to use. The first, gain on disposal of equipment. That's going in operating. The second, cash received, also known as the proceeds. That is going to go into our long-term, or our investing with our long-term assets. So at this point, I'm going to stop, and I'll create another podcast to move from this piece of information into creating our statement of cash flow. Lenore out.